Warren Buffett, who's been on this program many a time, privately traded in stocks that Berkshire Hathaway was buying and selling. Buffett has long said that such trading would be considered a conflict of interest. He's talked about this multiple times, that he does have a separate private trading account separate from Berkshire, but has said that he can't be buying the same stocks as Berkshire. But the outlet, this is ProPublica, reviewed a leaked confidential IRS records. You remember they got those records, which were now deemed illegally taken, not by ProPublica, but by somebody else who then took that and gave it to ProPublica, and have found several instances of such trades.
Welcome to Finance Reacts. In today's episode, we are going to take a deep dive into Warren Buffett and the recent ProPublica controversy. ProPublica published a story on Warren's personal investment account transactions, which were leaked through IRS tax returns. This video will break down the crux of the article's allegations, in which ProPublica accuses Buffett of hypocritically violating Berkshire policy of insider trading by performing sell actions on two different securities during a time period in which Berkshire Hathaway was either buying or selling those same securities. As of the time of this video, Berkshire or Warren have not released a statement addressing these allegations. My hope is by the end of this video, you have been given enough information and facts to make your own judgments regarding the ethical nature of these stock transactions by Warren. Let's get started. On November 9, 2023, ProPublica published their story headlined, "How Warren Buffett Privately Traded Stocks That Berkshire Hathaway Was Buying and Selling." In the article, they give three specific examples of transactions that took place between 2009 and 2012. We will be examining two of them. Before we dive into these examples, I think it's important to provide some additional information regarding Warren's views on the topic to give you, the audience, some better context.
A couple of questions on this topic. You said in an interview on CNBC that you had bought shares in JP Morgan for your personal account. Can you explain how you decide to make a personal investment versus one in your role as a fiduciary for us as shareholders of Berkshire? And while you're at it, could you please share some names of stocks you've recently bought for your own account?
Well, the truth is I like Wells Fargo better than I like JP Morgan, but I also, and we've bought and we're buying Wells Fargo stock, and that takes me out of the business of buying Wells Fargo. So therefore I go into something that I don't like quite as well, but that I still like very much. And that's one of the problems I have, is that I can't be buying what Berkshire is buying, and I've got some money around, and therefore I go into my second choices or into tiny little companies like I did with Korean companies and that sort of thing. But my best ideas are all in Berkshire, that I can promise you. You have 98.5% of your money in Berkshire, and you really are trying to do your thinking about what's best for the 1.5%, you're a little bit crazy. You should be thinking about Berkshire, which I can assure you I do.
I wouldn't ever urge them to do anything based on what we do. I mean, if they want to do what Berkshire does, they probably should buy Berkshire. But I'm not an investment advisor. You know, it's intellectual property that belongs to Berkshire, what we're doing with the securities. So we have no desire to encourage people to buy or sell stocks at all, except I will tell people that over time I think they will do very well by buying common stocks. And I think the best thing for most of them to do is to buy an index fund. I think they're making a big mistake if they're piggybacking me or 10 other people that they may, whose names appear in the paper. That is not a great strategy. A great strategy is just to buy stocks consistently over a lifetime and not worry too much about whether they go up or down in any given month or year.
The first example cited is Warren's sale of Wells Fargo stock on April 24, 2009. On April 20th, Warren Buffett had completed an interview with Fortune magazine, in which he had praised Wells Fargo's business model and stated Berkshire would be sticking by the bank through the financial crisis. Just 4 days later, Warren had sold a $20 million position in the bank in his personal investment account. So the question is, why would Warren sell the stock in his personal investment holdings while buying the stock under Berkshire Hathaway, where 99% of his net worth is held? The only logical assumption we can make is Warren sold to avoid the perception of an attempt to pump the stock up by buying it through Berkshire and praising it on television, while personally profiting from the shares he had held in his own account. The ProPublica article states from April 20th, the time the Fortune article was published, and April 24th, the time Buffett sold, the shares went up 13%, inferring a quick pump and dump gain by Warren. We can essentially rule this motivation out of the equation by diving deeper into the numbers. If Warren truly felt that Wells Fargo was undervalued on April 20th, he surely felt the stock was still undervalued with only another 13% appreciation gained by April 24th. We can be sure in Warren's logic in this regard by looking at Berkshire's purchases of Wells Fargo stock at that time, in which 99% of Warren's net worth was invested. Berkshire bought an estimated $450 million worth of Wells Fargo stock during the same time period and billions more in the following 2 years. It would be unreasonable to assume Warren sold Wells Fargo stock on April 24th because it had gained 13% and was now overvalued when 99% of his net worth was still technically buying Wells Fargo stock through Berkshire Hathaway during the same period. In money terms, Warren should have been much more concerned regarding Berkshire investment in Wells Fargo rather than his own. The reasonable inference we can make here is Warren didn't sell because he made a quick 13% profit. Instead, Warren sold because the stock had only went up 13% since his Fortune interview, and he had decided to sell the position in order to freely make public statements regarding the bank without being accused of pumping his own personal gain. Looking at the stock on April 24th, it had traded at a high of 21.97. At first glance, this may seem like a quick profit for Buffett, but we have to assume the world's greatest investor knew this stock would rise considerably more in the years to come, and the 13% gain from April 20th to April 24th, representing over $2.5 million of extra profit, would be an irrelevant numerical gain for someone who, in 2009, even after billions of dollars had come off his net worth, due to the financial recession and charitable donations worth billions to the Gates Foundation, was still worth $37 billion. Just 1 year later, Wells Fargo stock rose to over $33 a share. The implication that Warren sold what was clearly an undervalued security, while simultaneously buying the same security in the billions so he could net an additional few million dollars personally, while being worth $37 billion, seems to be quite the irrational inference. In the second example, ProPublica shows Buffett, in October of 2012, had sold $35 million in Johnson & Johnson stock, while Berkshire Hathaway was simultaneously selling out its position in Johnson & Johnson as well. The noteworthy fact here is Berkshire, in its quarterly filing, showed that it had only sold some of its position, and the following 2 quarter filings would show that Berkshire would go on to sell millions of additional shares of the company. The implication here is that Warren sold his shares first before the information could be spread that Berkshire was making significantly more sales of Johnson & Johnson, therefore the stock would not plummet on the news of Berkshire selling, and thus getting Buffett a higher selling price personally on his $35 million sale. Let's take a closer look into this inference by first asking the question, why would Berkshire spread the sale of its Johnson & Johnson position over several quarters? As historical practice, large money managers like Berkshire sell positions over a period of time due to a few different reasons. Some of these reasons can be for dollar cost averaging or selling in accordance with cash requirement needs, but in Berkshire's case, we can make the assumption that the stock was sold over a few quarters as to not impact the trading volume of the security, thus manipulating the stock price. Logically, it would be much worse for Berkshire for the trade action to be revealed in the second quarter while it still maintained a position due to the fact investors would see the selling of the stock and make the assumption that in the coming months Berkshire would be exiting the position and as a result triggering a sell-off of the security before Berkshire could liquidate its entire position. Here is Warren himself explaining that when Berkshire starts the sale of a position, with few exceptions, it usually means they are exiting the position in full.
When we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or like that. That's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
All right, the next
go
question.
ahead, I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So
We can see from the chart, during the time period Warren sold and the time period Berkshire had subsequently sold out its entire position, the stock price range had nearly stayed the same, essentially showing there was no real financial gain or loss by spreading out the sales over a few quarters, and no real financial benefit to Buffett by selling his position before Berkshire had finished selling its position. Although these actions cited by ProPublica show no real financial gain, and the thought of someone who is worth over $100 billion trying to make a few $1 million on pump and dump schemes, or timing sales by front-running transactions seems laughable, we do have to ask ourselves the question, if Warren is so aware and mindful of the perceptions regarding insider trading, whether in the legal context or the Berkshire Hathaway policy context, why go to such lengths to manage a personal portfolio? The amount in Warren's personal investment portfolio is a fraction of what he gives away to charity every year, and doesn't even represent 0.5% of his net worth. So why even allow the opportunity of a scandal to arise by making individual investments within the portfolio? Given the large discrepancy in the size of positions, surely Warren would have known he couldn't possibly sell his personal positions at the exact same time Berkshire Hathaway sold its position in the same equity, or that investors would naturally have questions on why Warren would sell something personally that Berkshire still owns. So why not just put his personal portfolio in an index fund to eliminate any possible appearance of wrongdoing? The gains in Warren's personal portfolio are financially inconsequential relative to his net worth. Frankly, they are even inconsequential relative to his own lifestyle expenses. So why even leave the door open to the perception of unethical behavior? That's a question I would be curious to get an answer to. Let me know your thoughts on the transactions below in the comments. Do you agree with my assumptions, or do you think there were different reasons behind Warren's decisions to conduct the transactions? If you found this explanation helpful, please give this video a like and subscribe to our channel so we can keep making original finance content.